Question 1. What factors determine the appropriate underwriting approach and product design for motor insurance policies covering autonomous vehicles, considering the evolving regulatory landscape and technological advancements? Option A. The vehicle's specific operational design domain OD, its safety validation and certification processes, and the manufacturer's cybersecurity protocols. Option B. The general perception of technological risk in the automotive sector, without detailed technical assessment. Option C. The historical claims experience of similar vehicle models, regardless of their autonomous capabilities. Option D. The availability of standard motor insurance wordings that can be easily adapted to include autonomous features. Correct answer is A. The vehicle's specific operational design domain OD, its safety validation and certification processes, and the manufacturer's cybersecurity protocols. Explanation. This scenario is professionally challenging because the rapid evolution of autonomous vehicle AV technology outpaces current regulatory frameworks and established insurance principles. Insurers must navigate uncertainty regarding liability, risk assessment, and product design in a landscape where the traditional driver-centric model is being fundamentally altered. Careful judgment is required to balance innovation with consumer protection and regulatory compliance. The correct approach involves a comprehensive assessment of the AV's operational design domain OD, its safety validation processes, and the specific technological capabilities and limitations. This aligns with the Financial Conduct Authority's FCA principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, by ensuring that products are suitable and information provided is clear and fair. It also reflects the spirit of the Insurance Distribution Directive, IDE, by promoting fair treatment of customers and ensuring products meet their needs. Understanding the ODD is crucial for accurate risk pricing and for communicating coverage limitations to policyholders, thereby avoiding misrepresentation and ensuring policy terms are understood. An incorrect approach that focuses solely on the vehicle's manufacturer without considering the AV's specific operational context and the role of software updates would fail to adequately assess risk. This could lead to underpricing or mispricing of policies, potentially breaching FCA Principle 3, Systems and Controls, by not having robust risk management frameworks. It also risks misinforming consumers about the scope of their cover, violating Principle 6 and Principle 7. Another incorrect approach that prioritizes historical claims data from traditional vehicles would ignore the unique risk profile of AVs. This would be a failure of due diligence and risk assessment, potentially leading to inadequate reserves and financial instability, contravening the FCA's prudential standards. It also fails to meet the needs of customers seeking cover for AVs, thus breaching Principle 6. Finally, an approach that relies on generic liability assumptions without deep technical understanding of the AV systems and their potential failure modes would be professionally negligent. This could result in policies that do not provide adequate protection or that impose unfair burdens on policyholders, directly contravening FCA Principles 6 and 7. The professional decision-making process for similar situations should involve a multidisciplinary team including actuaries, underwriters, legal experts, and technologists. This team should proactively engage with AV manufacturers, regulatory bodies, and industry bodies to stay abreast of technological advancements and evolving regulatory guidance. A robust framework for continuous monitoring and adaptation of underwriting and product development strategies is essential to manage the inherent uncertainties associated with emerging technologies like AVs. Question 2. Examination of the data shows that a client wishes to install a high-security, manufacturer-approved alarm system and a GPS tracking device on their insured vehicle. The client believes these additions will significantly reduce the risk of theft and therefore should not impact their premium or require notification to the insurer. As an insurance intermediary, what is the most appropriate course of action? Option A. Advise the client that they must inform their insurer of these modifications, as they represent a change to the insured risk, which could affect the policy terms and conditions. Option B. Advise the client that they can proceed with the installation without informing the insurer, as long as the devices are professionally installed. Option C. Inform the client that the insurer will automatically be notified of these devices through their approved installation network. Option D. Advise the client that since these are security enhancements, No notification to the insurer is necessary as they are designed to reduce risk. The correct answer is A. Advise the client that they must inform their insurer of these modifications, as they represent a change to the insured risk, which could affect the policy terms and conditions. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance the client's desire for vehicle modification with the insurer's underwriting requirements and regulatory obligations. The intermediary must ensure that any modifications do not invalidate the policy or lead to a claim being declined, while also acting in the client's best interest. This involves a thorough understanding of how security devices and modifications impact risk and premium, and the specific disclosure requirements under UK insurance law. The correct approach involves proactively advising the client that any modifications, including the installation of security devices, must be disclosed to the insurer. This is because modifications can alter the risk profile of the vehicle, potentially affecting the premium or even the insurer's willingness to provide cover. Failure to disclose such changes could lead to a breach of the policy terms and conditions, potentially resulting in a claim being repudiated. The intermediary has a duty of care to ensure the client understands their obligations under the Insurance Conduct of Business (ICOB's) rules, which mandate clear communication and fair treatment of customers. By advising disclosure, the intermediary upholds these principles and ensures the policy remains valid. An incorrect approach would be to assume that the installation of a security device automatically reduces risk and therefore requires no disclosure. This is a flawed assumption, as insurers assess risk based on a multitude of factors, and the specific type and effectiveness of the security device, as well as its installation, can all influence their underwriting decisions. Furthermore, simply stating that the device is for security purposes does not absolve the policyholder of their duty to inform the insurer of any material changes to the risk. Another incorrect approach would be to advise the client that no disclosure is necessary because the modification is a security enhancement. This misinterprets the concept of material fact disclosure. Any change that could influence the insurer's assessment of risk, whether perceived as positive or negative by the policyholder, must be disclosed. The intermediary's role is not to make this judgment call but to facilitate the correct disclosure process. Professionals should adopt a decision-making process that prioritizes client understanding and regulatory compliance. This involves 1. Identifying the core issue. The client is making a modification to their vehicle. 2. Assessing the potential impact on risk. Modifications can alter the risk profile. 3. Consulting relevant regulations. ICOB's mandates disclosure of material facts. 4. Communicating clearly with the client, explaining the need for disclosure and the potential consequences of non-disclosure. 5. Facilitating the disclosure process, guiding the client on how to inform their insurer. 6. Documenting the advice given, maintaining a record of the conversation and advice provided. Question 3. When evaluating the statistical models used for motor insurance pricing, an actuary discovers that a particular demographic group, while statistically showing a higher propensity for claims based on historical data, is not directly identifiable through protected characteristics within the model's inputs. However, the actuary suspects that the variables used when combined might be acting as proxies for these protected characteristics, leading to potentially unfair pricing. What is the most ethically and regulatorily sound approach for the actuary to take? Option A. Continue using the model as is, as long as the variables are not explicitly protected characteristics and the statistical correlation is valid to ensure accurate risk-based pricing. Option B. Immediately cease using the model and revert to a simpler, less accurate pricing structure to avoid any potential for indirect discrimination. Option C. Conduct a thorough investigation into the model's drivers, seeking to understand the underlying reasons for the observed correlation and assessing whether it represents a genuine risk factor or a proxy for unfair discrimination, and if necessary, adjust or supplement the model with controls to ensure fairness. Option D. Inform senior management of the statistical anomaly and recommend a price increase for the identified demographic group to compensate for the higher claims propensity, without further investigation into the model's underlying mechanisms. The correct answer is A. Continue using the model as is, as long as the variables are not explicitly protected characteristics and the statistical correlation is valid to ensure accurate risk-based pricing. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need for accurate risk assessment, which statistical modeling supports, with the ethical imperative to treat all customers fairly and avoid discriminatory practices. The use of statistical modeling in motor insurance, while a powerful tool for pricing and underwriting, can inadvertently perpetuate or create biases if not carefully managed. The challenge lies in ensuring that the models are robust, transparent, and do not lead to unfair outcomes for specific groups, even if those groups are identified through statistically significant correlations. The correct approach involves a thorough and ongoing review of the statistical models used for pricing and underwriting motor insurance. This includes not only validating the statistical accuracy of the models, but also critically assessing their potential impact on different customer segments. Insurers have a regulatory and ethical duty to ensure that pricing is fair and not unduly discriminatory. This means understanding the drivers of risk identified by the models and ensuring they are directly related to the likelihood and cost of claims, rather than proxies for protected characteristics or other unfair bases. Regular audits, stress testing of models under different scenarios, and a commitment to transparency in how models are developed and applied are crucial. This aligns with the principles of good governance and customer protection mandated by the Financial Conduct Authority, FCA in the UK, which oversees insurance markets. The FCA expects firms to understand their products, treat customers fairly, and manage risks effectively, including the risks associated with data and modeling. An incorrect approach would be to solely rely on the statistical output of a model without considering its real-world implications. For instance, if a model identifies a correlation between a particular postcode and higher claims, but this correlation is driven by socioeconomic factors that are not directly related to driving behavior or risk, continuing to price based on this alone could be considered unfair discrimination. This fails to meet the FCA's principles of treating customers fairly and ensuring products are designed and sold to meet the needs of identified customers. Another incorrect approach would be to ignore or downplay evidence of potential bias within a model, perhaps due to commercial pressure to maintain profitability. This demonstrates a failure in risk management and a disregard for ethical obligations, potentially leading to regulatory sanctions and reputational damage. A further incorrect approach would be to use data in a way that indirectly discriminates, even if direct discrimination is avoided. For example, using a proxy variable that is highly correlated with a protected characteristic, without a clear justification that it is a genuine indicator of risk, would be problematic. Professionals should adopt a decision-making process that integrates statistical expertise with a strong ethical framework and a thorough understanding of regulatory requirements. This involves 1. Understanding the data, scrutinizing the data used to build models for potential biases. 2. Model validation, not just for statistical accuracy but for fairness and interpretability. 3. Impact assessment, proactively evaluating how model outputs might affect different customer groups. 4. Governance and oversight, establishing clear lines of responsibility for model development, deployment, and ongoing monitoring. 5. Continuous improvement, being prepared to adapt models and processes as new data emerges or regulatory expectations evolve. This proactive and holistic approach ensures that statistical modeling serves its intended purpose of accurate risk assessment, without compromising ethical standards or regulatory compliance. Question 4. The performance metrics show a slight dip in new business conversion rates for motor insurance policies, and a senior manager has suggested that a more flexible interpretation of the no-claims discount (NCD) eligibility criteria for new customers could help boost these figures. Specifically, they propose that if a customer has a history of claims but can provide a plausible explanation for each, the NCD could be awarded at a higher level than strictly permitted by the standard policy wording, to secure the sale and improve the team's performance. What is the most appropriate course of action? Option A. Accurately apply the insurer's no-claims discount policy and relevant regulatory guidance to each customer's circumstances, ensuring the customer receives the NCD they are demonstrably entitled to, and clearly communicate this entitlement. Option B. Interpret the no-claims discount eligibility criteria in a more restrictive manner for all new customers to reduce the overall NCD payout and improve profitability, even if it means some customers may be unfairly denied a discount. Option C. Award a higher no-claims discount than strictly permitted by the policy wording, if the customer provides a plausible explanation for past claims to improve new business conversion rates and meet performance targets. Option D. Offer a no-claims discount that is higher than the customer is strictly entitled to, based on a subjective assessment of their potential future driving behavior, to secure the sale and improve immediate performance metrics. The correct answer is A. Accurately apply the insurer's no-claims discount policy and relevant regulatory guidance to each customer's circumstances, ensuring the customer receives the NCD they are demonstrably entitled to, and clearly communicate this entitlement. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's commercial objectives with the ethical obligation to treat customers fairly and adhere to regulatory requirements concerning no-claims discount, NCD. The pressure to meet performance targets could tempt an individual to overlook or misinterpret NCD rules, potentially leading to unfair outcomes for customers and breaches of regulatory conduct. Careful judgment is needed to ensure that customer entitlements are accurately assessed and communicated, even when it might impact short-term performance metrics. The correct approach involves accurately applying the insurer's NCD policy and relevant regulatory guidance to the customer's specific circumstances. This means verifying the customer's claim history and entitlement to NCD based on established rules, and then clearly communicating this entitlement to the customer. This approach is ethically sound and regulatorily compliant because it upholds the principle of treating customers fairly, ensuring they receive the benefits they are entitled to under the policy. The Financial Conduct Authority, FCA in the UK, which governs insurance products, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. Misrepresenting or unfairly withholding NCD would contravene these principles and potentially breach rules related to product governance and oversight and fair treatment of customers. An incorrect approach would be to interpret the NCD policy in a way that is overly restrictive or to apply it inconsistently to avoid a discount, even if the customer appears to meet the general criteria. This could involve making assumptions about the customer's eligibility without thorough verification, or using ambiguous policy wording to justify denying the discount. Such actions would be ethically problematic, as they could lead to customers being unfairly deprived of a benefit they have earned, impacting their trust and potentially causing financial detriment. Regulatorily, this would likely breach FCA principles, particularly those requiring firms to act in their customers' best interests and to ensure that products are designed and sold to meet the needs of identified target markets without causing foreseeable harm. It could also fall foul of specific rules regarding the fair application of policy terms and conditions. Another incorrect approach would be to offer a higher NCD than the customer is strictly entitled to in order to secure the sale or improve immediate performance metrics. While seemingly customer-friendly, this is also ethically and regulatorily unsound. It misrepresents the product's terms, potentially setting a false expectation for future renewals and creating an unsustainable pricing model. This could lead to future customer dissatisfaction and regulatory scrutiny for mis-selling or misrepresentation. It also undermines the integrity of the NCD system, which is designed to reward safe driving. The professional decision-making process for similar situations should involve a clear understanding of the relevant regulatory framework, particularly the FCA's principles for businesses and specific conduct of business rules. Professionals should always prioritize accurate application of policy terms and conditions, treating each customer's situation on its individual merits. When faced with ambiguity or pressure to deviate from fair practice, it is crucial to consult internal guidelines, seek clarification from supervisors or compliance departments, and always err on the side of customer fairness and regulatory compliance. Maintaining accurate records and being able to justify decisions based on policy and regulation is paramount. Question 5. The evaluation methodology shows that a policyholder has failed to disclose a previous modification to their vehicle that was not declared at the time of application for their motor insurance policy. The insurer's investigation suggests this modification, if known, would have significantly increased the risk profile. What is the most appropriate course of action for the insurer, considering their regulatory obligations and the policy terms? Option A. Offer the policyholder a retrospective premium adjustment to cover the increased risk without voiding the policy. Option B. Void the policy from inception due to the material breach of condition and refund the premium paid. Option C. Conduct a full investigation into the materiality of the undisclosed modification and communicate findings and proposed actions to the policyholder. Option D. Immediately cancel the policy with immediate effect and retain the premium paid to cover administrative costs. The correct answer is B. Void the policy from inception due to the material breach of condition and refund the premium paid. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's contractual obligations with the customer's potential misunderstanding or deliberate omission of information. The challenge lies in interpreting the breach of condition in the context of the policy terms and the FCA's principles for business, particularly those relating to treating customers fairly and providing clear, accurate information. A careful judgment is needed to determine if the breach is material and warrants voiding the policy, or if it's a minor issue that should be handled differently. The correct approach involves a thorough investigation into the nature and materiality of the breach of condition. This means assessing whether the undisclosed information, if known at the time of underwriting, would have led the insurer to decline the risk or charge a significantly higher premium. The insurer must then communicate its findings and proposed course of action clearly and transparently to the policyholder, explaining the implications of the breach and offering any available alternatives, such as amending the policy terms or offering a pro rata refund if the policy is voided from inception. This aligns with the FCA's Principle 6, Customers' Interests, and Principle 7, Communications with Clients, ensuring fair treatment and clear communication. It also reflects the legal principle that a breach of condition can lead to policy voidance, but this power must be exercised reasonably and with due regard to the policyholder's rights. An incorrect approach would be to immediately void the policy without a proper investigation into the materiality of the breach. This fails to treat the customer fairly and may breach FCA principles by not acting in the customer's best interests or by communicating in a way that is not clear, fair, and not misleading. Another incorrect approach would be to ignore the breach altogether, as this would expose the insurer to potential claims that were not underwritten and could lead to financial losses, and it would also be a failure to uphold the contractual terms of the policy. Furthermore, simply offering a full refund without considering the period of cover provided would be an inadequate response and could be seen as unfair to the insurer, while also potentially not fully resolving the customer's situation if they believed they were covered. The professional decision-making process for similar situations should involve a structured approach. 1. Investigate the alleged breach of condition thoroughly. 2. Assess the materiality of the breach. Would it have affected the underwriting decision or premium? 3. Review the specific policy wording and relevant legal precedents. 4. Communicate findings and proposed actions clearly and empathetically to the policyholder, explaining the rationale. 5. Consider all available options, including policy amendment, voidance with appropriate adjustments, or other resolutions. 6. Ensure all actions comply with FCA regulations and the principles of treating customers fairly. Question 6. Regulatory review indicates that a policyholder has reported their vehicle stolen. The policyholder is distressed and states they have already filed a police report. The insurer's standard procedure for theft claims involves a waiting period of 14 days for the police to recover the vehicle before initiating settlement discussions, and requires the policyholder to provide proof of ownership and any outstanding finance details. The policyholder is concerned about their ability to commute to work and is requesting immediate assistance. Which of the following represents the most appropriate course of action for the insurer? Option A. Acknowledge the policyholder's distress and the police report. Explain the standard claims process, including the 14-day waiting period for recovery, and offer to explore interim solutions such as a courtesy car or assistance with alternative transport arrangements while the investigation proceeds, subject to policy terms. Option B. Inform the policyholder that the standard 14-day waiting period must be observed and that all required documentation must be submitted before any further action can be taken, while acknowledging their distress. Option C. Immediately initiate the settlement process for the stolen vehicle, as the policyholder is distressed and has provided a police report to ensure fair treatment. Option D. Advise the policyholder that while the police report is noted, the insurer will require additional independent verification of the theft and ownership, potentially involving a visit to the policyholder's residence, before proceeding with any part of the claim. The correct answer is B. Inform the policyholder that the standard 14-day waiting period must be observed and that all required documentation must be submitted before any further action can be taken, while acknowledging their distress. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to verify the legitimacy of a claim with the policyholder's right to fair treatment and prompt settlement. The potential for fraud exists, but so does the risk of unfairly delaying or denying a genuine claim, which could lead to regulatory breaches and reputational damage. The core tension lies in conducting a thorough investigation without causing undue distress or financial hardship to the claimant. The correct approach involves a balanced and proportionate investigation. This means gathering necessary information to assess the claim's validity, such as police reports and evidence of ownership, while also communicating clearly and empathetically with the policyholder. It prioritizes a timely resolution once sufficient evidence is obtained, adhering to the principles of good faith and fair dealing expected under UK insurance regulations. This approach respects the policyholder's position while fulfilling the insurer's obligations. An incorrect approach would be to immediately suspect fraud and impose excessive, burdensome, or intrusive investigative measures without reasonable grounds. This could involve demanding documentation that is difficult or impossible for the policyholder to obtain, or making assumptions about the claimant's honesty. Such actions could breach the Insurance Conduct of Business (ICOB's) rules, specifically those relating to treating customers fairly and handling claims efficiently. Another incorrect approach is to rush the settlement without adequate verification, which exposes the insurer to financial risk and potential regulatory scrutiny for failing to manage its business prudently. Professionals should approach such situations by first establishing clear internal procedures for handling theft claims that are compliant with ICOB's. This includes defining what constitutes reasonable evidence for a theft claim and setting service standards for claim investigation timelines. When a claim is lodged, the professional should assess the information provided against these standards. If further investigation is required, it should be proportionate to the circumstances and clearly communicated to the policyholder, explaining the reasons for the request and the expected timeline. Maintaining open communication and demonstrating a commitment to a fair and timely resolution are paramount. Question 7. The risk matrix shows an increased likelihood of claims involving older vehicles where the cost of repair is approaching the vehicle's market value. In such situations, an insurer is considering how to best settle a claim for a damaged vehicle. Which of the following approaches best aligns with the regulatory framework and principles of fair treatment for motor insurance policyholders? Option A. Proposing a cash settlement that is significantly lower than the estimated cost of repair, arguing that it represents a cost-effective resolution for the insurer. Option B. Offering a cash settlement based on the insurer's internal assessment of the vehicle's depreciated value, regardless of the cost of repair or replacement. Option C. Offering the policyholder a choice between a repair settlement, a replacement vehicle of equivalent specification, or a cash settlement reflecting the reasonable cost of repair or replacement, with clear explanations of each option. Option D. Prioritizing a repair settlement, even if the repair cost is close to the vehicle's market value, to minimize the insurer's immediate outlay. Correct answer is B. Offering a cash settlement based on the insurer's internal assessment of the vehicle's depreciated value, regardless of the cost of repair or replacement. Explanation. This scenario is professionally challenging because it requires balancing the insurer's operational efficiency and cost-effectiveness with the policyholder's right to a fair and appropriate settlement, all within the strict confines of the Motor Insurance Products Exam (CII) regulatory framework. The insurer must navigate potential conflicts of interest and ensure that the chosen method of settlement genuinely addresses the loss sustained by the policyholder, adhering to principles of good faith and fair dealing. The correct approach involves offering the policyholder a choice between repair, replacement, or cash settlement, where each option is presented fairly and transparently, and the cash settlement reflects the actual cost of repair or replacement. This aligns with the CII's emphasis on treating customers fairly and ensuring that policy terms are clear and understandable. The regulatory expectation is that the insurer acts in the policyholder's best interest by providing a settlement that restores them to their pre-loss position, and offering a genuine choice empowers the policyholder. A cash settlement should be based on the cost of repair or replacement, not an arbitrary figure designed to benefit the insurer. An incorrect approach would be to steer the policyholder towards a specific settlement method, such as repair, without adequately exploring the other options or ensuring the cash settlement accurately reflects the cost of repair or replacement. This could be seen as a failure to treat customers fairly, potentially leading to the policyholder receiving less than they are entitled to. Forcing a repair when a replacement is more appropriate, or offering a cash settlement that is demonstrably lower than the cost of a comparable repair or replacement, would breach the principles of good faith and could be subject to regulatory scrutiny. Another incorrect approach would be to offer a cash settlement that is significantly less than the market value of a comparable vehicle or the cost of repair, without a clear and justifiable reason, thereby failing to indemnify the policyholder adequately. Professional decision-making in such situations requires a thorough understanding of the policy terms, the extent of the damage, and the available settlement options. It involves clear communication with the policyholder, explaining the pros and cons of each method, and ensuring that the chosen settlement genuinely meets their needs and the insurer's obligations under the policy and relevant regulations. The insurer must always prioritize the policyholder's financial well-being and their right to a fair outcome. Question 8. The assessment process reveals that a policyholder's vehicle, parked legally, sustained damage from an uninsured driver. The policyholder holds a comprehensive motor insurance policy. Which of the following represents the most appropriate initial action for the insurer to take regarding the policyholder's claim? Option A. Deny the claim outright, stating that damage caused by a third party is not covered by the policyholder's comprehensive insurance. Option B. Investigate the claim under the policyholder's comprehensive section, and if covered, proceed with settlement and subsequent recovery from the Motor Insurers Bureau. Option C. Delay the claim assessment until the uninsured driver has been identified and their liability confirmed, even if this process is lengthy. Option D. Advise the policyholder to directly pursue their claim with the Motor Insurers Bureau without any initial assessment by the insurer. Correct answer is B. Investigate the claim under the policyholder's comprehensive section, and if covered, proceed with settlement and subsequent recovery from the Motor Insurers Bureau. Explanation. The assessment process reveals a scenario where a policyholder's vehicle, while parked legally, was struck by an uninsured driver, causing significant damage to the parked vehicle. The policyholder has comprehensive motor insurance. This scenario is professionally challenging because it requires the claims handler to navigate the policyholder's expectation of immediate coverage against the specific terms and conditions of their comprehensive policy, particularly concerning uninsured driver incidents and the recovery process. Careful judgment is required to balance policyholder satisfaction with adherence to regulatory requirements and contractual obligations. The correct approach involves the insurer investigating the claim under the policyholder's comprehensive section, specifically looking for coverage related to accidental damage, even if caused by an uninsured third party. This typically includes assessing whether the policy wording allows for such claims and then initiating the claims process. Crucially, the insurer would then pursue recovery from the Motor Insurers Bureau (MIB) under the relevant RTA, Road Traffic Act, provisions, as the responsible party is uninsured. This approach is correct because it aligns with the principles of indemnity under the policy, ensuring the policyholder is compensated for their loss as per their contract, and it correctly utilizes the established legal framework for dealing with uninsured drivers in the UK, as governed by the RTA and associated MIB agreements. This upholds the spirit of compulsory motor insurance by ensuring victims of uninsured drivers are not left without recourse. An incorrect approach would be to immediately deny the claim on the basis that the damage was caused by a third party, implying the policyholder's policy does not cover third-party actions. This is a regulatory failure because it overlooks the comprehensive nature of the policy, which is designed to cover a wide range of accidental damage, including that caused by uninsured drivers. It also fails to acknowledge the insurer's obligation to pursue recovery through the MIB, which is a fundamental part of the UK's motor insurance framework for such situations. Another incorrect approach would be to advise the policyholder to claim directly from the MIB without first assessing the claim under their own policy. This is an ethical and regulatory failure, as it bypasses the contractual relationship between the insurer and the policyholder. The insurer has a duty to process claims under the policy they have issued. Furthermore, It could lead to administrative complications and potential disputes regarding the extent of coverage and the insurer's role in the recovery process. A third incorrect approach would be to delay the assessment of the claim significantly, citing the need to first identify and pursue the uninsured driver. This is a professional failure as it demonstrates a lack of understanding of the established procedures for uninsured driver claims. The regulatory framework, particularly through the MIB, is designed to provide a mechanism for compensation when the responsible party cannot be identified or is uninsured, and the insurer should initiate the appropriate process promptly. The professional decision-making process for similar situations should involve 1. Thoroughly reviewing the policy wording to understand the scope of comprehensive cover and any specific exclusions related to third-party actions or uninsured drivers. 2. Investigating the circumstances of the incident to confirm the facts, including the uninsured status of the third party. 3. Applying the policy terms to the facts to determine coverage under the policyholder's comprehensive insurance. 4. If covered, initiating the claims process to indemnify the policyholder. 5. Simultaneously, understanding and applying the relevant RTA provisions and MIB agreements to pursue recovery from the MIB as the responsible party is uninsured. 6. Communicating clearly and promptly with the policyholder throughout the process, managing their expectations regarding timelines and outcomes. Question 9. The control framework reveals that a customer who has been driving for less than 2 years is requesting a specific type of motor insurance policy that offers extensive cover but has a significantly higher premium than other available options. The customer states they want this policy because a friend recommended it. What is the most appropriate course of action for the intermediary to ensure compliance with conduct of business rules? Option A. Proceed with the sale of the requested policy, as the customer has explicitly asked for it and provided a reason. Option B. Advise the customer that the requested policy is too expensive for their experience level and recommend a basic, cheaper policy instead. Option C. Explain the benefits and drawbacks of the requested policy, explore the customer's specific driving needs and risk profile, and recommend the most suitable policy based on this assessment, even if it differs from the initial request. Option D. Inform the customer that their friend's recommendation is not a valid basis for selecting insurance and refuse to proceed with the sale. The correct answer is A. Proceed with the sale of the requested policy, as the customer has explicitly asked for it and provided a reason. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance the commercial imperative of securing a sale with the fundamental regulatory obligation to act in the customer's best interests. The intermediary must navigate a situation where a customer's stated preference might not align with their actual needs or the most suitable product available, potentially leading to a sale that is not appropriate. Careful judgment is required to ensure compliance with the FCA's principles for businesses, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients, as well as specific conduct of business rule related to product suitability and advice. The correct approach involves actively probing the customer's understanding of their needs and the implications of their stated preference, explaining the benefits and drawbacks of alternative options, and documenting the advice given. This demonstrates a commitment to understanding the customer's circumstances and providing a recommendation that is genuinely in their best interests, even if it deviates from their initial request. This aligns with regulatory expectations that firms must take reasonable steps to ensure that products are suitable for their customers and that customers are provided with clear, fair, and not misleading information. An incorrect approach would be to simply accept the customer's stated preference without further investigation. This fails to meet the obligation to understand the customer's needs and could result in the sale of a product that is not appropriate, leading to potential customer detriment and regulatory breaches. Another incorrect approach would be to push a more expensive product without clearly demonstrating its superior suitability for the customer's specific circumstances, potentially breaching rules on fair treatment and transparency. Finally, failing to adequately document the advice provided and the rationale behind the recommendation leaves the firm vulnerable to regulatory scrutiny and unable to demonstrate compliance if a complaint arises. Professionals should adopt a structured decision-making process that prioritizes understanding the customer's needs, assessing their knowledge and experience, explaining options clearly, and documenting all advice and decisions. This involves asking open-ended questions, actively listening to the customer's responses, and using that information to guide the recommendation process, always with the customer's best interests at the forefront. Question 10. Research into motor insurance product offerings has revealed that a client, a young driver with a history of minor speeding offenses, is seeking the most cost-effective policy. The intermediary has identified several risk mitigation techniques that could potentially lower the client's premium. Which of the following approaches best aligns with the regulatory framework for providing advice on motor insurance products in the UK? Option A. Recommending the purchase of a basic insurance policy with minimal cover, as this will inherently be the cheapest option available. Option B. Recommending a combination of advanced driver training courses and the installation of a telematics device, explaining how these can demonstrate safer driving habits to insurers and potentially lead to lower premiums over time. Option C. Advising the client to declare their vehicle as being used for social, domestic, and pleasure purposes only, even if they occasionally use it for commuting, to secure a lower initial premium. Option D. Suggesting the client simply accept the lowest quoted premium without exploring any risk mitigation, as this directly addresses their stated priority of cost savings. The correct answer is B. Recommending a combination of advanced driver training courses and the installation of a telematics device, explaining how these can demonstrate safer driving habits to insurers and potentially lead to lower premiums over time. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance the client's immediate desire for lower premiums with their long-term need for adequate protection against potential motor insurance claims. The intermediary must act in the client's best interests, which involves providing advice that considers not just cost, but also the effectiveness of risk mitigation techniques in reducing the likelihood and severity of claims, thereby influencing future premiums and overall financial well-being. This requires a deep understanding of how different risk mitigation strategies are viewed by insurers and how they align with regulatory expectations for responsible advice. The correct approach involves recommending a combination of risk mitigation techniques that demonstrably reduce risk and are supported by evidence or industry best practice. This aligns with the Financial Conduct Authority's (FCA) principles, particularly Principle 6, Customers' Interests, and Principle 7, Communications with Clients. By suggesting practical measures like advanced driver training and the installation of telematics devices, the intermediary is providing advice that is tailored to the client's circumstances and aims to improve their risk profile. This proactive approach helps the client understand how their behavior impacts their insurance costs and encourages responsible driving, which is in their long-term financial interest and contributes to road safety, a broader societal benefit implicitly supported by insurance regulation. An incorrect approach would be to solely focus on the client's stated preference for the cheapest option without adequately exploring or recommending risk mitigation. This fails to meet the duty to act in the customer's best interests, as it prioritizes short-term cost savings over potentially significant long-term benefits of reduced claims and premiums. It also risks breaching the FCA's principles by not providing advice that is suitable and appropriate for the client's needs, potentially leading to underinsurance or higher future costs if claims do occur. Another incorrect approach would be to recommend risk mitigation techniques that are not genuinely effective or are based on unsubstantiated claims. This could mislead the client and fail to achieve the desired reduction in risk or premiums. Such advice would contravene the FCA's Principle 7 regarding clear, fair, and not misleading communications, and could expose the intermediary to regulatory action and reputational damage. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's needs and priorities. Ascertain their budget, risk tolerance, and any specific concerns they have. 2. Assess the client's risk profile. Consider factors like driving history, vehicle type, usage, and location. 3. Identify relevant risk mitigation techniques. Research and understand the effectiveness and insurer acceptance of various methods. 4. Explain the benefits and drawbacks. Clearly communicate how each technique can impact premiums, claims likelihood, and overall cost of insurance, referencing any supporting evidence or insurer policies. 5. Recommend suitable options. Propose a range of solutions that balance cost, protection, and risk reduction, empowering the client to make an informed decision. 6. Document the advice. Maintain clear records of the discussions and recommendations provided. Question 11. To address the challenge of a customer inquiring about a claim for damage caused by a flood, where the motor insurance policy contains an exclusion for damage arising from flooding, what is the most appropriate course of action for the insurance intermediary to take? Option A. Advise the customer that the damage is not covered because the policy excludes flood damage, without further elaboration on the specific exclusion. Option B. Inform the customer that the damage is not covered due to the flood exclusion, and then clearly explain the specific wording of the exclusion clause from the policy document, detailing what it means in the context of their claim. Option C. Assume the customer understands the implications of a flood exclusion and simply state that the claim cannot be processed. Option D. Tell the customer that while flood damage is generally excluded, the specific circumstances might allow for an exception, without confirming this with the insurer. The correct answer is B. Inform the customer that the damage is not covered due to the flood exclusion, and then clearly explain the specific wording of the exclusion clause from the policy document, detailing what it means in the context of their claim. Explanation. The scenario presents a professional challenge because it requires an insurance intermediary to interpret and apply complex policy terms, specifically exclusions, in a way that is both legally compliant and ethically sound, ensuring the customer's understanding and fair treatment. The intermediary must navigate the potential for ambiguity in policy wording and the regulatory obligation to provide clear and accurate information. The correct approach involves the intermediary proactively identifying the relevant exclusion clause, understanding its precise scope and limitations as defined by the policy wording and relevant UK legislation and Financial Conduct Authority (FCA) guidelines, and then clearly communicating its implications to the customer. This aligns with the FCA's principles of treating customers fairly (TCF) and ensuring that customers receive clear, accurate, and not misleading information about their insurance products, including what is not covered. The intermediary's duty of care extends to ensuring the customer is fully aware of the policy's limitations before a claim arises. An incorrect approach of simply stating that the damage is not covered without referencing the specific exclusion clause fails to provide the customer with the necessary clarity and justification. This breaches the TCF principle by not being transparent about the policy's limitations and could lead to customer dissatisfaction and potential complaints. Another incorrect approach of assuming the customer understands the exclusion without explicit explanation is also professionally unacceptable. This overlooks the intermediary's responsibility to ensure comprehension and relies on an assumption that could be detrimental to the customer, particularly when dealing with potentially complex policy language. This also contravenes the FCA's focus on clear communication and avoiding assumptions about customer knowledge. A further incorrect approach of downplaying the exclusion to avoid upsetting the customer is ethically and regulatorily unsound. While maintaining a positive customer relationship is important, it cannot come at the expense of providing accurate and complete information about the policy's coverage. This misrepresentation, even if unintentional, can lead to a false sense of security for the customer and a failure to meet regulatory expectations for transparency. Professionals should adopt a decision-making process that prioritizes understanding the policy terms thoroughly, identifying all relevant exclusions and conditions, and then communicating these clearly and transparently to the customer. This involves a commitment to accuracy, fairness, and ensuring the customer has a realistic understanding of their insurance coverage. Question 12. Analysis of a client's understanding of motor insurance. A client states, "I want comprehensive cover because it means everything is covered, no matter what happens to my car." Which of the following explanations by an insurance advisor best addresses the limitations of comprehensive coverage in line with regulatory expectations for clarity and fairness? Option A. Comprehensive cover is indeed our most extensive option, protecting you against a wide range of incidents like accidents, fire, and theft, which is why it's generally recommended. Option B. Comprehensive insurance is designed to be the most complete protection available, so you can be confident that most eventualities will be handled. Option C. Comprehensive cover is the highest level of protection, and while it covers most common issues, you should always check the specific policy document for full details. Option D. While comprehensive cover is our broadest policy, it's important to understand it doesn't cover everything. For instance, it typically excludes wear and tear, mechanical breakdowns, and damage resulting from driving under the influence of alcohol or drugs. The correct answer is A. Comprehensive cover is indeed our most extensive option, protecting you against a wide range of incidents like accidents, fire, and theft, which is why it's generally recommended. Explanation: this scenario is professionally challenging because it requires the insurance advisor to accurately distinguish between different levels of motor insurance coverage and explain their limitations to a client who may have a limited understanding of insurance jargon. The client's perception of comprehensive coverage can be a significant source of misunderstanding, leading to potential dissatisfaction or disputes if their expectations are not aligned with the policy's actual terms. The advisor must navigate this by providing clear, concise, and accurate information, adhering strictly to the regulatory requirements for product disclosure and advice. Correct approach involves clearly articulating that comprehensive motor insurance, while broad, is not absolute and has specific exclusions and limitations. This aligns with the Financial Conduct Authority's (FCA) principles, particularly Principle 7, Communications with Clients, which mandates that firms must pay due regard to the information needs of their clients and communicate information to them in a way that is clear, fair, and not misleading. The advisor must explain that while comprehensive cover typically includes accidental damage, fire, and theft, it does not cover wear and tear, mechanical breakdown, or damage caused by driving under the influence, for example. This detailed explanation ensures the client understands the scope and boundaries of their coverage, managing expectations effectively, and fulfilling the duty of care. An incorrect approach would be to simply state that comprehensive cover is the best or most complete option without detailing its limitations. This is misleading and fails to meet the FCA's requirement for clear and fair communication. It could lead the client to believe they have protection against all eventualities, which is rarely the case with any insurance policy. Another incorrect approach would be to focus solely on the benefits of comprehensive cover without mentioning any potential exclusions. This omits crucial information that the client needs to make an informed decision and understand what is not covered. This omission violates the principle of providing a fair and balanced view of the product. A further incorrect approach would be to assume the client understands insurance terminology and to use technical jargon without explanation. This fails to cater to the client's information needs and could result in them not fully grasping the implications of the coverage limitations. The professional decision-making process for similar situations should involve a structured approach. 1. Understand the client's needs and risk appetite. 2. Clearly identify the different types of motor insurance available and their core features. 3. Crucially, identify and articulate the specific limitations and exclusions of each coverage level, especially for comprehensive policies, referencing the policy wording. 4. Communicate this information in a clear, fair, and not misleading manner, using plain language and providing opportunities for the client to ask questions. 5. Ensure the client understands the implications of these limitations for their specific circumstances. 6. Document the advice provided and the client's understanding. Question 13. The investigation demonstrates that a policyholder who has a comprehensive motor insurance policy recently fitted a performance-enhancing exhaust system to their car. They did not inform their insurer of this modification, believing it to be minor and unlikely to affect the vehicle's insurance risk. The insurer has now discovered this modification during a routine review of vehicle registration data. What is the most appropriate course of action for the insurer to take, considering the policyholder's duty to notify? Option A. Accept the modification without further inquiry, assuming it has no impact on the insurance risk. Option B. Impose a significant retrospective premium increase without further investigation to cover the perceived increased risk. Option C. Immediately void the policy and refuse all claims, citing a breach of the duty of disclosure. Option D. Investigate the materiality of the exhaust system modification to the risk and the policyholder's knowledge of their disclosure obligations. Then determine the appropriate action based on the findings, which may include policy adjustment or, in severe cases, avoidance. The correct answer is C. Immediately void the policy and refuse all claims, citing a breach of the duty of disclosure. Explanation: the investigation demonstrates a scenario where a policyholder has failed to notify their motor insurer of a significant modification to their vehicle. This situation is professionally challenging because it requires the insurer to balance their contractual obligations with the need to uphold the principles of utmost good faith and the regulatory requirements surrounding motor insurance. The insurer must assess the impact of the undisclosed modification on the risk profile of the policy, considering the potential for increased claims and the fairness to other policyholders who adhere to disclosure rules. Careful judgment is required to determine the appropriate course of action, which could range from endorsement of the policy to voiding it, depending on the materiality of the change and the policyholder's intent. The correct approach involves a thorough investigation into the nature of the modification, its potential impact on the vehicle's safety and performance, and the policyholder's awareness of their duty to disclose. This approach aligns with the principles of the Insurance Act 2015, which governs the duty of fair presentation. Specifically, the Act requires policyholders to disclose every material circumstance which the policyholder knows or ought to know, or failing that, take reasonable steps to satisfy themselves that they have complied with this duty. The insurer must then assess whether the failure to disclose was deliberate, reckless, or innocent, and whether the modification was material to the risk accepted. If the failure was innocent and the modification was not material, the policy might be adjusted. If material and the failure was not innocent, the insurer may have grounds to avoid the policy or adjust claims. This approach upholds regulatory expectations for fair treatment of customers and adherence to contractual terms. An incorrect approach would be to automatically void the policy without a proper investigation. This fails to consider the nuances of the Insurance Act 2015, which mandates a proportionate response based on the policyholder's conduct and the materiality of the undisclosed information. Such an action could be deemed unfair and potentially breach consumer protection regulations. Another incorrect approach would be to accept the modification without any adjustment or further inquiry, assuming it has no impact. This disregards the policyholder's duty of disclosure and the insurer's right to accurately assess risk. It could lead to underpricing of risk, potentially impacting the insurer's solvency and the fairness of premiums for other policyholders, and contravenes the principle of utmost good faith. A further incorrect approach would be to impose a punitive premium increase without clear justification linked to the increased risk posed by the modification. While premium adjustments are possible, they must be demonstrably linked to the change in risk and communicated transparently to the policyholder, in line with regulatory guidance on fair pricing and transparency. The professional decision-making process for similar situations should involve a systematic review of the policy terms, relevant legislation, primarily the Insurance Act 2015 in the UK context, and internal underwriting guidelines. It requires gathering all relevant facts, assessing their materiality, evaluating the policyholder's conduct, and applying a fair and proportionate response that is consistent with regulatory requirements and ethical principles. Question 14. During the evaluation of a motor insurance application, an underwriter is reviewing various factors to determine the appropriate premium. Which of the following approaches best aligns with regulatory requirements for fair and accurate risk assessment in motor insurance pricing? Option A. Prioritizing the driver's claims history, driving experience, the vehicle's safety features and age, and the declared annual mileage, while ensuring these factors are supported by actuarial data. Option B. Assigning a higher premium based solely on the applicant's postcode, assuming that residents of certain areas are inherently higher risk. Option C. Using the applicant's occupation as the primary factor for premium calculation, without specific evidence linking that occupation to increased driving risk. Option D. Adjusting the premium based on the applicant's age and gender, even if actuarial data does not strongly support a significant risk differential for these specific factors in the current market. The correct answer is A. Prioritizing the driver's claims history, driving experience, the vehicle's safety features and age, and the declared annual mileage, while ensuring these factors are supported by actuarial data. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the need for accurate risk assessment with the regulatory obligation to avoid unfair discrimination. The underwriter must consider a range of factors that genuinely influence the likelihood and severity of motor insurance claims, while simultaneously ensuring that these factors do not lead to discriminatory pricing based on protected characteristics or irrelevant proxies for risk. The challenge lies in discerning which data points are legitimate indicators of risk and which are not, and in applying underwriting principles consistently and fairly. The correct approach involves a thorough and objective assessment of factors demonstrably linked to driving behavior and accident probability. This includes considering the driver's history, the vehicle's characteristics, and the intended use of the vehicle. This approach is justified by regulatory frameworks that permit risk-based pricing, provided it is based on sound actuarial principles and does not discriminate unfairly. The Financial Conduct Authority, FCA in the UK, for instance, expects firms to treat customers fairly and to ensure that pricing is not discriminatory. Underwriting decisions must be evidence-based and justifiable, focusing on factors that predict future claims. An incorrect approach would be to use factors that are not demonstrably linked to risk or that act as proxies for protected characteristics. For example, using an individual's postcode as a primary determinant of risk without a clear, demonstrable, and actuarially sound link to accident frequency or severity in that specific area, beyond general socioeconomic assumptions, could be problematic. This could inadvertently discriminate against individuals based on their location, which may correlate with protected characteristics. Similarly, using an individual's occupation as a sole or primary underwriting factor without a clear, evidence-based rationale for how that occupation directly impacts driving risk is likely to be considered unfair and potentially discriminatory. The FCA's principles require that pricing is not unfair and that firms do not treat customers unfairly. Relying on broad assumptions or stereotypes rather than individual risk assessment fails to meet these standards. Professionals should adopt a decision-making framework that prioritizes data-driven risk assessment, ensuring that all underwriting factors are actuarially sound and demonstrably linked to the likelihood of claims. This involves regular review of underwriting criteria to ensure they remain relevant and fair, and a commitment to avoiding proxies for protected characteristics. When in doubt, seeking guidance from actuarial departments and ensuring compliance with regulatory guidance on fair treatment of customers and non-discriminatory pricing is paramount. Question 15. The risk matrix shows a client is seeking motor insurance primarily to ensure they can drive legally and are protected from unexpected financial burdens arising from vehicle damage or third-party claims. When discussing the product, the intermediary is considering different ways to explain the purpose of motor insurance. Which approach best aligns with the definition and purpose of insurance within the regulatory framework? Option A. State that the main purpose is to allow them to drive on public roads without fear of immediate legal repercussions, as it's a mandatory requirement. Option B. Explain that motor insurance is a contract where the insurer agrees to compensate the policyholder for financial losses arising from specific defined events outlined in the policy, such as damage to their vehicle or liability to others, thereby transferring the financial risk of these events from the policyholder to the insurer. Option C. Highlight that the insurance guarantees a significant payout if they have any kind of accident, ensuring they won't have to pay for any repairs or damages out of their own pocket. Option D. Emphasize that this insurance will cover everything that could possibly go wrong with their car or any accident they might be involved in, acting as a complete financial safety net for all their worries. The correct answer is B. Explain that motor insurance is a contract where the insurer agrees to compensate the policyholder for financial losses arising from specific, defined events outlined in the policy, such as damage to their vehicle or liability to others, thereby transferring the financial risk of these events from the policyholder to the insurer. Explanation. This scenario presents a professional challenge because it requires an insurance intermediary to balance the immediate financial interests of a client with their fundamental duty to ensure the client understands the true nature and purpose of the insurance product being purchased. The intermediary must avoid misrepresenting the product or creating a false sense of security, which could lead to significant client dissatisfaction and potential regulatory breaches. The core of the challenge lies in the ethical obligation to provide clear, accurate, and unbiased advice, even when it might mean a sale is less straightforward. The correct approach involves clearly explaining that motor insurance is designed to provide financial protection against specified risks, such as damage to the insured vehicle, third-party liability, and potentially other specified losses, as outlined in the policy terms and conditions. It is crucial to emphasize that insurance is a risk transfer mechanism, not a guarantee against all possible negative outcomes or a savings product. This approach aligns with the regulatory framework's emphasis on treating customers fairly, ensuring transparency, and providing adequate product information. Specifically, the Financial Conduct Authority, FCA, in the UK, which governs this exam, mandates that firms must act honestly, fairly, and professionally in accordance with the best interests of their clients. This includes ensuring that customers understand the products they are buying and the limitations of that cover. Misrepresenting insurance as a form of investment or a guarantee against all eventualities would breach these principles. An incorrect approach that suggests the insurance will cover everything and act as a safety net for all financial worries fails to accurately define the purpose of insurance. This misrepresents the product as a comprehensive financial solution rather than a specific risk mitigation tool. Ethically, this is misleading and could lead the client to believe they have protection they do not, violating the duty of care and the principle of transparency. Such a statement also breaches regulatory requirements by failing to provide clear and fair information about the product's limitations. Another incorrect approach that focuses solely on the immediate benefit of driving legally, without elaborating on the scope of cover and exclusions, is also problematic. While driving legally is a consequence of having motor insurance, it does not fully define the purpose of the insurance itself. This approach omits crucial information about what the insurance actually covers and, importantly, what it does not, thereby failing to provide a complete and fair understanding of the product. This omission can lead to a client making assumptions about their cover that are not borne out by the policy terms, resulting in a breach of the duty to provide adequate information. A third incorrect approach that highlights the potential for a payout in the event of an accident, without contextualizing it within the policy's terms and conditions, is also misleading. While a payout is a possible outcome, it is contingent on the specific circumstances of the accident and whether those circumstances fall within the scope of the policy's cover. Presenting it as a simple guarantee of financial recovery, without mentioning the need to adhere to policy terms and conditions, and the existence of excesses or exclusions, is a form of misrepresentation. This fails to meet the regulatory standard of providing clear, fair, and not misleading information. Professionals should adopt a decision-making process that prioritizes client understanding and regulatory compliance. This involves actively listening to the client's needs and concerns, then explaining the product's purpose and limitations in clear, jargon-free language. It requires a commitment to honesty and transparency, even if it means a sale is more challenging. The professional should always refer to the policy documentation and ensure the client understands key aspects such as cover levels, exclusions, excesses, and the claims process. This proactive approach builds trust and ensures the client makes an informed decision, thereby upholding both ethical standards and regulatory obligations. Question 16. Operational review demonstrates that a policyholder has made a claim for their classic car, which was stolen. The sum insured on the policy is £30,000. The policyholder believes the car is worth £35,000 due to its unique modifications and excellent condition. The insurer's initial assessment, based on standard market guides for similar vehicles, suggests a pre-loss market value of £28,000, which approach best upholds the principle of indemnity and regulatory requirements for handling this claim. Option A. Offer the policyholder £30,000, as this is the sum insured and the policyholder's stated belief of value. Option B. Offer the policyholder £35,000, as this is the policyholder's stated belief of the car's value and reflects its unique nature. Option C. Offer the policyholder £28,000, as this is the insurer's assessed pre-loss market value and the sum insured is higher. Option D. Offer the policyholder £28,000, but inform them that due to underinsurance, the payout will be proportionally reduced based on the sum insured. The correct answer is A. Offer the policyholder £30,000, as this is the sum insured and the policyholder's stated belief of value. Explanation. This scenario is professionally challenging because it requires the assessor to apply the principle of indemnity accurately, which aims to put the policyholder back in the financial position they were in immediately before the loss, without allowing for profit or underinsurance. The difficulty lies in interpreting the policy terms and market values correctly, especially when dealing with older or modified vehicles where direct replacement cost might be ambiguous. Careful judgment is required to ensure fairness to both the policyholder and the insurer, adhering strictly to the principles of indemnity and the relevant regulatory framework for motor insurance in the UK. The correct approach involves assessing the market value of the vehicle immediately prior to the loss, considering its age, condition, mileage, and any modifications, and comparing this to the sum insured. If the market value is less than the sum insured, the payout should be limited to the market value. If the market value is higher, the payout is limited to the sum insured, provided the policy is not subject to average underinsurance. This approach upholds the principle of indemnity by ensuring the policyholder receives compensation that reflects the actual value of their loss, preventing them from profiting from the claim. This aligns with the Insurance Conduct of Business Sourcebook (ICOB's) requirements, particularly regarding fair treatment of customers and accurate claims handling. An incorrect approach would be to automatically offer the sum insured regardless of the vehicle's pre-loss market value. This fails to adhere to the principle of indemnity, potentially overcompensating the policyholder and allowing them to profit from the loss, which is contrary to insurance law and ICOB's principles. Another incorrect approach would be to deduct an arbitrary amount for wear and tear beyond what is reflected in the market value assessment. This could lead to underindemnification, leaving the policyholder in a worse financial position than before the loss, which is also a breach of indemnity principles and ICOBs. Finally, failing to consider the policy's average clause where applicable would also be an incorrect approach, as it could lead to underindemnification if the vehicle was underinsured relative to its market value. The professional reasoning process should involve 1. Understanding the policy terms and conditions, including the sum insured and any average clauses. 2. Accurately determining the market value of the insured item immediately before the loss, using appropriate valuation methods and expert advice if necessary. 3. Applying the principle of indemnity, ensuring the payout does not exceed the market value or the sum insured, whichever is lower, and accounting for underinsurance if applicable. 4. Communicating the settlement offer clearly and transparently to the policyholder, explaining how the figure was reached in accordance with the policy and regulatory requirements. Question 17. Comparative studies suggest that a significant proportion of motor insurance application fraud stems from applicants providing inaccurate details regarding their driving history or vehicle usage. An applicant for a motor insurance policy declares they have had no claims in the last 5 years. However, during the underwriting process, a check reveals a minor incident recorded by a third-party data provider that the applicant did not disclose. The underwriter's primary objective is to accurately assess the risk presented by the applicant. Which of the following approaches best aligns with the regulatory framework and ethical obligations for handling this situation? Option A. Proceed with underwriting the policy at the declared premium, but make a note on the file to monitor for future issues. Option B. Contact the applicant to seek clarification on the undisclosed incident, explaining the importance of accurate disclosure and the potential consequences of non-disclosure. Option C. Immediately assume fraudulent intent and decline the application, informing the applicant of their failure to disclose. Option D. Accept the applicant's original declaration without further investigation, as the incident was minor and not a claim in the traditional sense. The correct answer is C. Immediately assume fraudulent intent and decline the application, informing the applicant of their failure to disclose. Explanation. This scenario is professionally challenging because it requires the applicant to balance the insurer's need to accurately assess risk with the applicant's right to privacy and the potential for unintentional errors or omissions. Misrepresenting information, even if not deliberately fraudulent, can lead to incorrect underwriting decisions, impacting both the insurer's financial stability and the policyholder's coverage. The Financial Conduct Authority (FCA) Handbook, specifically in relation to General Insurance Conduct of Business (GCOB) and Insurance Conduct of Business (ICOBs), places a strong emphasis on treating customers fairly and ensuring that consumers understand the products they are buying. This includes the duty of disclosure. The correct approach involves diligently verifying the information provided by the applicant and seeking clarification on any discrepancies or ambiguities. This aligns with the FCA's principles of acting with integrity, skill, care, and diligence, and in the best interests of customers. Specifically, GCOB 3. 1R and ICOB 7. 1R require firms to ensure that information provided by customers is accurate and complete to the best of their knowledge and belief, and that customers are made aware of their duty of disclosure. By proactively seeking clarification and ensuring the applicant understands the implications of their statements, the firm upholds these regulatory requirements and ethical obligations. An incorrect approach that involves immediately assuming fraudulent intent based on a minor discrepancy without further investigation fails to treat the customer fairly. This could breach ICOB 6.1.1r, which requires firms to provide clear, fair, and not misleading information. It also fails to uphold the principle of acting with integrity and skill, care, and diligence. Another incorrect approach, that of accepting the information at face value without any verification, despite a clear indication of potential inaccuracy, neglects the insurer's responsibility to underwrite risk appropriately and could lead to adverse selection, ultimately harming other policyholders. This also contravenes the duty to act with skill, care, and diligence. A third incorrect approach, which involves immediately canceling the policy without allowing the applicant an opportunity to correct or explain the information, is overly punitive and may not be proportionate to the nature of the discrepancy, potentially leading to a breach of treating customers fairly. The professional decision-making process for similar situations should involve a structured approach. First, identify any potential misrepresentations or non-disclosures. Second, assess the materiality of the discrepancy. How significant is it to the risk being insured? Third, seek clarification from the applicant, explaining the importance of accurate information and their duty of disclosure. Fourth, if clarification resolves the issue, proceed with underwriting. If the applicant is unwilling or unable to provide satisfactory clarification, then consider the appropriate course of action, which may include adjusting premiums, imposing terms, or, in cases of clear and deliberate fraud, declining cover or voiding the policy, always in line with regulatory guidance and the policy terms and conditions. Question 18. Governance review demonstrates that a motor insurance underwriter is considering an applicant's proposal. The applicant has a clean driving license, drives a modest vehicle for commuting, and has no previous claims. However, the applicant lives in an area that the insurer's data suggests has a higher incidence of vehicle crime and traffic accidents. The underwriter is contemplating increasing the premium significantly based on this postcode data, despite the applicant's otherwise low-risk profile. Which approach best aligns with regulatory requirements and ethical underwriting practices? Option A. Decline cover outright due to the higher risk associated with the applicant's postcode. Option B. Assess the applicant's individual risk profile based on their driving history, vehicle usage, and declared circumstances, and use postcode data as a secondary, contributing factor only if demonstrably linked to the applicant's specific risk. Option C. Offer a standard premium, ignoring the postcode data to ensure fairness to all applicants in that area. Option D. Increase the premium based on the postcode data, as it represents a statistically higher risk for the area. Correct answer is D. Increase the premium based on the postcode data, as it represents a statistically higher risk for the area. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to accurately assess risk for pricing and underwriting purposes with the ethical obligation to treat all applicants fairly and avoid discriminatory practices. The temptation to use readily available but potentially biased data points to simplify risk assessment must be weighed against the regulatory imperative to ensure that underwriting decisions are based on objective, relevant factors that directly correlate with the likelihood of a claim. The correct approach involves a nuanced assessment of the applicant's driving history, vehicle usage, and declared circumstances, using these factors to inform a risk-based premium without resorting to broad generalizations or assumptions that could lead to unfair discrimination. This aligns with the principles of fair underwriting, which are underpinned by regulatory frameworks designed to prevent adverse selection and ensure that premiums reflect individual risk. Specifically, the Financial Conduct Authority, FCA in the UK, which governs the motor insurance products exam, emphasizes the need for insurers to treat customers fairly and to ensure that pricing and underwriting practices are not discriminatory. This means that, while insurers can differentiate based on risk, the factors used must be demonstrably linked to risk and applied consistently. An incorrect approach would be to automatically assign a higher premium based solely on the applicant's postcode without further investigation into their actual driving patterns or the specific risks associated with that area. This could be considered unfair discrimination, as it penalizes individuals based on a characteristic, residence, that may not accurately reflect their personal driving risk. The FCA's principles require that pricing is transparent and justifiable, and relying on postcode alone without considering individual circumstances could violate these principles. Another incorrect approach would be to decline cover or impose an excessively high premium based on a single, minor past driving conviction that occurred many years ago and has no bearing on the applicant's current driving behavior. This fails to consider the applicant's overall driving record and their potential for future safe driving, potentially leading to unfair treatment and a failure to meet the duty of care owed to consumers. A further incorrect approach would be to use information about the applicant's occupation that is not directly related to their driving habits or the type of vehicle they intend to insure, such as their profession's perceived social status. This would be a form of indirect discrimination, as it uses a proxy for risk that is not objectively justifiable and could lead to unfair pricing. The professional decision-making process in such situations requires a commitment to ethical conduct and regulatory compliance. Professionals must 1. Understand the applicant's circumstances thoroughly, gathering all relevant information. 2. Apply underwriting criteria consistently and fairly, ensuring that factors used to assess risk are directly related to the likelihood of claims. 3. Be transparent with applicants about how their premium has been calculated. 4. Regularly review underwriting practices to ensure they remain compliant with regulatory requirements and ethical standards, avoiding any form of unfair discrimination. Question 19. Investigation of a motor insurance claim for damage sustained to a vehicle during a rally event reveals a dispute over coverage. The policy's operative clause provides cover for accidental damage. However, the policy document also contains a specific exclusion for damage sustained during organized racing or pacemaking. An endorsement, however, states that cover is provided for damage sustained during participation in organized rallies, provided the vehicle is not modified for racing. The vehicle in question was participating in a rally and was not modified for racing. Based on the principles of interpreting motor insurance policy wording within the UK regulatory framework, which section of the policy is most likely to dictate the final coverage decision in this scenario? Option A, the definitions section, as it clarifies the meaning of accidental damage. Option B, the endorsement specifically addressing participation in organized rallies. Option C, the exclusion for damage sustained during organized racing or pacemaking. Option D, the operative clause providing cover for accidental damage. The correct answer is D, the operative clause providing cover for accidental damage. Explanation: this scenario is professionally challenging because it requires the underwriter to interpret the interplay between different sections of a motor insurance policy, specifically the operative clause, definitions, exclusions, and endorsements, to determine coverage. Misinterpreting these sections can lead to incorrect claims handling, customer dissatisfaction, and potential regulatory breaches. Careful judgment is required to ensure that the policy's intent and the regulatory requirements are both met. The correct approach involves a systematic review of the policy wording, starting with the operative clause to understand the scope of cover, then examining the definitions to clarify any ambiguous terms, and critically assessing the exclusions to identify any limitations. Finally, any endorsements must be considered, as they can modify or add to the standard policy terms. This methodical process ensures that all relevant policy sections are considered in conjunction, leading to an accurate coverage determination that aligns with the Financial Conduct Authority's (FCA) principles, particularly those relating to treating customers fairly and ensuring policies are clear, fair, and not misleading. An incorrect approach of solely relying on the operative clause without considering exclusions would fail to acknowledge the limitations of the cover, potentially leading to the denial of a valid claim or the acceptance of an invalid one, both of which contravene the FCA's principles. Another incorrect approach of focusing only on exclusions without understanding the operative clause would lead to an overly restrictive interpretation of the policy, potentially denying cover that was intended. Ignoring endorsements would be a significant failure, as these are legally binding amendments that alter the policy's terms and must be accounted for. Each of these incorrect approaches demonstrates a lack of thoroughness and a failure to apply the policy as a whole, risking regulatory censure and damage to the firm's reputation. Professionals should adopt a decision-making framework that prioritizes a comprehensive and integrated review of all policy sections. This involves understanding the purpose of each section, how they interact, and how they collectively define the scope of cover. When faced with ambiguity, professionals should consult internal guidelines, seek clarification from senior colleagues, or refer to relevant FCA guidance to ensure a fair and compliant outcome. Question 20. Compliance review shows that a policyholder has declared the installation of a performance enhancement chip and an aftermarket alarm system on their vehicle. As an underwriter, what is the most appropriate approach to assessing the risk associated with these modifications? Option A. Accept the policyholder's declaration at face value and apply a standard premium, assuming all declared modifications are beneficial or neutral to risk. Option B. Conduct a detailed risk assessment, verifying the specifications and potential impact of both the performance enhancement chip and the aftermarket alarm system on the vehicle's overall risk profile, and adjust terms accordingly. Option C. Decline coverage immediately due to the presence of aftermarket modifications, as they are inherently uninsurable. Option D. Automatically assume the alarm system reduces theft risk, and the chip has no significant impact on accident risk, proceeding with standard underwriting. The correct answer is D. Automatically assume the alarm system reduces theft risk, and the chip has no significant impact on accident risk, proceeding with standard underwriting. Explanation. This scenario is professionally challenging because it requires an underwriter to balance the potential for reduced risk presented by security devices and modifications against the possibility of misrepresentation or non-disclosure by the policyholder. Insurer has a duty to assess risk accurately to ensure fair pricing and solvency, while the policyholder has a duty to provide accurate information. The challenge lies in determining whether the modifications are genuinely risk-reducing, and if the policyholder has adequately disclosed them in a way that aligns with regulatory requirements. The correct approach involves a thorough risk assessment that considers the specific nature of the security devices and modification. This includes verifying the installation and effectiveness of any security devices and evaluating how the modifications might impact the vehicle's performance, handling, or susceptibility to theft or damage. This aligns with the regulatory framework's emphasis on accurate risk assessment and underwriting principles, ensuring that premiums reflect the actual risk presented. It also upholds the principle of utmost good faith by ensuring the insurer has a complete and accurate picture of the risk. An incorrect approach would be to automatically assume that any modification or security device inherently reduces risk without proper verification. This could lead to underpricing the risk and potential financial losses for the insurer. It also fails to address the possibility that the policyholder may not have fully disclosed the extent or nature of the modifications, which could invalidate the policy. Another incorrect approach is to automatically reject coverage or impose prohibitive terms solely based on the presence of modifications, without undertaking a proper risk assessment. This could be seen as unfair to the policyholder and may not be in line with the principles of offering appropriate cover where risk can be managed. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes 1. Understanding the policyholder's disclosure. What has the policyholder declared regarding modifications and security devices? 2. Verifying information. Where possible and appropriate, seek evidence of installation, certification, or manufacturer specifications for security devices and modifications. 3. Assessing impact on risk. Evaluate how each modification or device affects the vehicle's risk profile, e.g., increased performance might increase accident risk, enhanced security might decrease theft risk. 4. Applying underwriting guidelines. Determine if the assessed risk falls within the insurer's risk appetite and pricing structures. 5. Communicating clearly. Inform the policyholder of the insurer's decision and the reasons behind it, including any conditions or premium adjustments.